BB and below book that was there, which was the sub-investment grade book, I think that went up by 6,000 crores. And it's important to recognize that the 6,000 crores increase came only from two names, from exposures to the financial services sector, and which is now reflecting in the MTM that we've taken for the quarter. So the slippages were not 6,000 crores, the slippages were roughly about 4,500 crores.
Okay, where does this BB and below and watch list stand? And what is the distinction really when you anticipate future stress? Which book are you looking at?
So the genesis of the watch list really is that what we wanted to do was look at our sub-investment grade book very closely and see where were the potential slippages that could have accrued in the short term. And we wanted to flag those to investors before raising capital rather than doing so post. So it was drawn out of the BB and below book.
Okay.
The BB, and as far as the slippages are concerned, roughly about 2,500 crores have come from the watch list, and the balance has come from the BB and below book.
Okay, where does the watch list stand now? I believe as of last quarter it was 10,000 crores.
Yes.
And where is the BB and below rated book now?
So last year, for the last quarter, the BB and below book was 23,000 crores, and the watch list was 10,000 crores.
And the watch list was part of this 23,000
Exactly
crores.
right. So the watch list of 10,000 crores remains the same. And even though only 2,500 crores has slipped, we continue to look at the balance 7,500 crores very closely. As far as the BB and below book is concerned, that is the one that has grown from 23,000 crores to 29,000 crores, and we think it has now peaked. We don't see a further expansion in this book. On the contrary, as resolutions happen, and we expect at least a couple of those resolutions to happen this quarter, you will actually see that book contract.
So, how much of this BB and below book, which includes the watch list, do you expect will see some slippages in the next quarter or so?
So one of the sectors which we often talk about and which has a lot of analyst and investor interest is really the real estate book of Yes Bank. So the real estate book of Yes Bank is about 24,000 crores. 25% of that book already has been captured in our BB and below book and in our NPAs. As far as the balance 75% of that book is concerned, it is completely top class. It has seen minimal impairment. And if I look at even from a SMA2 perspective on that entire book, it's roughly about 240 crores. Okay. And if or 250 crores. And if I look and I put that aside, for the rest of my corporate book, SMA2 would be about 150 crores. Okay. So what I'm saying is that the SMA2 on our overall corporate book is about 404 crores.
DHFL, ADAG, SL, these are recognized companies, which are known in the market for the stress, and we, assume that they were part of your BB and below rated books. Now there are new names coming up, Cox and Kings, there's Everready, there is Syntex. Which of these new names in the market do you have exposure to, and therefore what would the total size of the stressed book that you're looking at be?
If you look at our BB and below book, which we had put out in the last quarter, it had the entity of Cox and Kings, which eventually slipped in this quarter. So it's not as if that it was something which was unforeseen or it was something that we had not anticipated.
Okay.
That name was very much part of the BB and below book,
okay,
and it slipped. So it wasn't a surprise. And like I said, that the entire 4,500 crores of slippages for this quarter have actually come entirely from the BB and below book, of which, like I said, the watch list was a subset.
So, at 5% GNPA levels, where do you see this stabilizing for the bank when you're confident that it will not worsen from there?
If you look at our BB and below book, it's not a very large granular book. It's not somewhere which is deeply colored by a particular sector or a particular industry. So this is not that has a derivative of a cycle. This is just a handful of concentrated exposures, and which could, when the resolution happens, turn around very quickly too. So like I said that of the names that are there in the BB and below book, I definitely see resolution happening on at least two of those names in this quarter.
Which would be? DHFL is that one of them, or ILNFS?
It may not be right for me. It may not be right for me to take those names, but two very material exposure which are there in the BB and below book, which I think will find resolution in this quarter, and which will again substantially reduce our BB and below book. Substantially.
So what is the number that you'll be targeting then? From 5% GNPAs, where do you see yourself stabilizing?
So it could be a significantly lower number.
Okay, I know you've given a 125 basis point credit cost guidance, but
Yes.
that is factoring in all of these new accounts, including the Andhra renewable energy crisis now. It should not rise below, above 125.
No, so we were very clear in terms of our credit cost guidance. Our credit cost for the first quarter is 32 basis points,
Yeah.
and this is at a time when we haven't seen recoveries, and a lot of the headwinds that that some of these names has faced is front loaded. So every reason to believe that we will come within our credit cost guidance of 125 basis points for the year.
What about your coverage for some of these stress loans as well that you've spoken about? 43%, are you satisfied with that?
No, I think very clearly as a bank we want to get to a level which is closer to 60%.
60%.
What we had said was that we will not compromise on the 43% which was there last quarter, and we maintain that even for this quarter.
How much capital do you require, and how much would it be for growth, and how much would be required to make provisions and for cleanup?
Even in a year like this, if you look at the pre-provisioning operating profit that we generated, that in itself is enough for me to be able to make provisions on the BB and below book for any slippages that
So
happen.
you only need growth capital?
So I have enough. The PPOP that I'm generating, even in a quarter of consolidation, and it'll only grow from here, is sufficient over the next 8 quarters for me to be able to provide for any slippages that may occur in the BB and below book.
Okay.
So the capital that we're looking to raise right now is purely growth capital.
Okay.
And I would again just reiterate this point: this is not being raised to heal the balance sheet. This is just pure growth capital.
So you saw a 10% growth in advances in this quarter compared to the previous year. What sort of growth are you anticipating for which you need the capital?
So I think once we have the capital in place, what we would like to ideally grow at is in the mid-20s. Our aspiration is really to be able to grow in that ballpark. And if you look at the current market opportunity and the dislocation that exists in some of the sector vectors of the financial services industry, I think the market opportunity is very compelling.
So how much capital then, is my question, do you need to get to that mid-20s growth level?
So we will also accrue capital organically, accrete capital organically. So it's difficult to put a number on that.
But a rough estimate that you would have had?
No, I think we'll go with the a basic thumb rule for banking that more capital is better than less,
Right.
and that's something that we are in very close discussion with investors right now in terms of what is the structure, what is the size, what is the composition of that capital, and we will raise whatever is needed.
How much would, could you give us a ballpark? Is it $1 billion? Is it 1.2, $1.5 billion? How much do you require?
I think those numbers, would see us through in the medium
$1 billion?
term. In the medium term as well.
Okay.
So we don't need to raise that much. We always have the option to be able to phase that out as well.
Okay.
But the number that you are talking about will actually solve for our credit needs for the medium term as well.
So am I to read this as $1 billion approximately in one or more phases?
So like I said, that we don't have a number which is boxed down just yet. But I'll go with the thumb rule that more capital is better than less.
All right. In the event that your share price has fallen significantly in the last month or so, it's now at 98. At this level, with your current market capitalization, and given that RBI does not allow an entity, a sovereign wealth fund, to even hold more than 10%, would you be looking to bring in 1, 2, 3, 4? I mean, how many investors would you need to bring on board to raise the kind of capital that you're speaking of?
Yeah, so I think clearly there are multiple options. One is that we do private equity plus a public markets transaction. Or we just do a public markets transaction, or we get a clutch of private equity players to be able to come in and solve for the capital that we decide to finally raise, given the fact that there are restrictions with regard to how much a single entity could hold.
Yeah.
All those options are available, and all those options are on the table as we speak.
Yeah, we're aware of all of these options being on the table, but given that you said you're looking to raise this capital in the current quarter,
Yes.
in the second quarter, how many such players are you in talks with?
So again, I think these are confidential discussions that we have.
If you could give us a number as to how many investors you would need to bring on board.
I think all that I would like to say at this point in time is that over a period of time, one of the things that investors have seen is that if you look at the Yes Bank asset portfolio and you see the issues that need resolution, those issues are just a handful. And each of those resolutions increases their upside materially, which has obviously made them very interested, made them very engaged. So we have multiple dialogues which are on as we speak.
Okay.
And I think between all of them, we can solve for our entire credit needs, capital needs, sorry.
To what extent are you willing to dilute? That's another question that we wanted an answer to.
I think every stakeholder of the bank, and when I say every stakeholder, I mean every stakeholder of the bank, is completely aligned to doing whatever is in the best interest of the bank, whatever enables the bank to be in a much stronger position to grow at a much more robust pace. So we are very flexible in terms of the level of dilution, but
is there a cap that you have in mind?
So what we went out with, and which is what the market believes, is either $1 billion or 10%, whichever is lower.
What sort of guidance could you give the markets in terms of growth, in terms of raising capital, in terms of improving your asset quality that should repose the faith of investors, where we've seen a lot of negativity surrounding the stock in the near term?
I have consistently maintained that the concerns around Yes Bank's asset quality has been overdone. From here on, you will see a very robust recovery in terms of the overall book, which is the sub-investment grade, and which should translate into much higher revenues.